In this lesson, we're going to identify the major drivers of GDP growth. GDP stands for Gross Domestic Product, which is the total value of all goods and services produced within a period of time. If we want to know the size of an economy, we look at the total GDP. But if we want to know how fast an economy is growing, we use the GDP growth rate, which measures the rate of growth. For example, India may be the 6th largest economy in the world, but it's actually number 1 for growth, which attracts many investors. The GDP growth rate is a key signal for investors to base investment decisions. An increasing growth rate is a positive signal for the stock market because it implies a rise in earnings growth. GDP is made up of 4 components: consumer spending, government spending, business spending, and global trade. Now, the big question here is what drives GDP growth? The 3 main drivers of GDP are population growth, debt growth, and productivity growth. Let's start with population growth. Populations expand through the combination of birth rates and immigration rates, the amount of people born, and the amount of new people coming into the country. After World War II, the U.S. saw the largest population boom in its history. The population boom happened primarily through birth rates, and this generation is known as the baby boomers. During the baby boomers era, the U.S. economy was the largest it had ever been as a percentage of world GDP. For example, from 2000 to 2020, the U.S. made up around 25% of the world's economy. But from 1946 to 1964, the U.S. made up around 40% of the world's economy. And this showcases the dominance of the baby boomers' economy. The population boomed, the economy boomed, and the stock market boomed. Now, in the same way that plants need water to grow, economies need people to expand. When you have more people, you have more earners. If you have more earners, you have more spenders, and that means more GDP. But when you have more people, you also have more labor. That means more production, more things are made, more GDP. However, population growth has its limits. Population growth requires infrastructure. When we talk about infrastructure, we're talking about schools, roads, housing, healthcare, transportation, food stores, and a justice system. Infrastructures are physical and organizational systems that support the functioning of a growing society. Without infrastructure, a growing population will produce less resources. Less available resources leads to poverty and crime. In the late 20th century, Latin America, Africa, and India experienced population booms. However, their economies did not grow because they lacked infrastructure. Population growth alone is not enough to get investors interested. There must be enough infrastructure to generate GDP growth. The upside to population growth is an increase in production and an increase in consumption, which usually leads to more GDP. But the downside is that it does require modern infrastructure. Okay, now that we know population growth contributes to GDP growth, let's move on to the second driver, debt growth. Debt growth is loan creation. It is the accumulation of liabilities from financing activities. All loans are forms of debt growth. Credit cards, auto loans, mortgage loans, business loans, and government loans. As of 2024, non-government debt, known as private sector debt, is about 3 times the size of US GDP, or about 200% of GDP. In the last 100 years, government debt, known as public debt, grew 82,500% from $4 billion to $33 trillion. And this makes total U.S. debt somewhere around $98 trillion. In a 20-year span, GDP grew 65%, while the U.S. debt burden grew a whopping 550%. The takeaway is simple. Debt growth is out of control, and it easily outpaces GDP. It makes you wonder, would the U.S. economy survive without debt growth? Likely not in this system. Okay, let's dive into a more simplified version of how debt is created to support growth. Debt is created from financial institutions and governments to fuel spending and production. So basically, debt growth is used to finance economic growth. And we learned this in the last lesson. Debt growth is financing. As a general rule, more debt equals more GDP. But of course, debt is not free. There's always an interest payment attached. Bigger debt burdens yield bigger interest payments, and bigger interest payments mean less GDP because those interest payments are taken from GDP. In April of 2024, U.S. interest payments exceeded $100 billion per month, which at the time meant the U.S. government was paying more monthly interest than the 67th largest economy was worth all year. Although debt can grow the economy, it also means bigger interest payments. And if interest rates go up, interest payments balloon even more. So eventually all that debt comes full circle and begins to eat away at GDP growth, causing a recession or even a financial crisis. After the 2008 global financial crisis, the government created more debt to revive the economy, and central banks left rates at zero for nearly 10 years to make sure those interest payments were as small as possible. So what happens if you can no longer lower interest rates and the debt continues to build? Now this can get very complicated very quickly, so we're going to keep this as simple as possible. Governments borrow money by issuing government bonds to the market. They are basically creating a loan with a credit and a debt attached. The credit is spent into the economy while the debt burden grows. This is government debt, also known as public debt. Now, banks also create loans with consumers and businesses. Those loans yield credits that are spent into the economy while the debt burdens grow. This is non-government debt, known as private debt. Eventually, these debts have to be paid back, or at least we believe these debts might get paid back. But if we look over the past 100 years, debts keep growing. And if debts keep growing, you run into a negative event, or monetization. When debt burdens become too large, the debt itself is financed, and we call this monetization. Central banks create new money and exchange it for debt, essentially absorbing some of the burden away from the system. Now, this is how monetization plays out. When debt burdens are too large to be paid back and the risk of defaulting threatens the entire financial system, the central bank steps in by printing money, purchasing the debt from the government or financial institutions, essentially adding new money to the banking system and reducing the debt burden. That debt is added to the central bank's account as an asset because debts are still someone's obligation to pay. Ultimately, the central bank is absorbing different forms of debt. Mortgage debt in the form of mortgage-backed securities, corporate debt in the form of corporate bonds, and government debt in the form of U.S. Treasury bonds. What's actually happening is money printing. Central banks create new money and exchange it for debt that is becoming a burden to the system. The result is an increase in money supply or money supply growth, which devalues the currency. Money printing increases the supply of money, making it more abundant, less scarce, and less valuable. You remember the golden rule: the more supply of something increases, the less valuable it becomes. Because the debt is denominated in currency, when the value of the currency shrinks, the value of the debt also shrinks. Think of a pie with 10 pieces. 8 pieces are cheese, the money supply, and 2 pieces are pepperoni, the debt. The debt is 2/10 of the pie, or 20%. If we add more slices of cheese, printing more money, each slice of cheese becomes smaller. Each unit of currency is worth less. The pepperoni also becomes a smaller piece of the pie, 1/10 or 10%. When the central bank monetizes the debt shrinks as a percentage of the pie, which is another trick that lowers the debt burden, allowing the system to not go bust. The debt burden did shrink, preventing financial collapse, but so did each unit of currency. It loses value. The less valuable the currency, the less purchasing power it actually has. In 1944, $1 had the purchasing power to attain 20 bottles of Coca-Cola, but today that $1 can purchase maybe a McDonald's coffee. So debt may contribute to growing the economy, to growing GDP, but it also means less purchasing power for the currency, which means your dollar is worth less. The upside of debt growth is that it can boost investment and boost GDP. The downside is it results in a higher cost of living. We call this inflation, a loss of purchasing power, and bigger debt burdens with crushing interest payments. Debt growth grows GDP, but it always comes with a price. Okay, so we've gone through population growth, we've gone through debt growth, and that leaves us with productivity growth. But this one is special, and before we get there, I want you to take the quiz, and we're going to contribute a whole lesson just to productivity growth. That's how special it is.